Okay, 3, 2, 1.
Hello, everybody. It's Mike Jardine here. Welcome to Mike's Monday, the second episode. I'd like to just take the opportunity to thank everybody that contacted me after the first episode, saying how much they enjoyed it in the bite-sized pieces and all the questions that came across later. It was great to see some really good questions. Hopefully, I managed to answer them all. And also for some ideas for content going forward, which again is much appreciated. And if anybody has other ideas for some content for future Mike's Mondays, just send them across to me on an email. As I say, it's much appreciated, and this is all part of helping you to understand AML and help you to get it right. Well, in relation to today's episode, we're going to be looking at, if I just share my screen, AML legislation, and it's got number 1 there in brackets because, as I say, bite-sized chunks, so we can cover it off in sections at a time. And this one is, today we're going to be looking at risk, and it's all about identification and the mitigation of risk. It's an essential part of any business, really, but in particular with yourselves as bookkeepers. And it's in order to meet the specific compliance requirements of the legislation, which appears to be ever growing, and more responsibility being placed on us all as the years go by. But in order to understand what the risks are to you and your practice and your reputation, you need to fully understand that before you can mitigate it. And if you don't know what they are, you can't mitigate it. It sounds obvious, but that's the way it is. Each practice is required to have a person responsible for compliance with the legislation, and along with a money laundering reporting officer. And if you're a sole trader, then it's the buck stops with you. And if you're any other type of practice where you've got staff employed, then that can be delegated to somebody else to do on the practice's behalf, which I'll come on to that in a later episode in relation to the money laundering reporting officer. So how I see it, there's 6 key functions in relation to risk and its identification. The first one, as I've just said there, identification of the risks. Secondly, the prevention of the risk, i.e. the mitigation. The monitoring of controls that you've got in place to mitigate the risks for their effectiveness, and don't be afraid to change those controls as it develops. The detection of any failings that are in relation to the risk. The resolution of issues that crop up. And then number 6, the reporting of any suspicious activity. So it's important to understand those areas so we can hopefully mitigate the risks and protect yourselves, protect the practice, identify money launderers, and report any suspicion to the powers to be. So each year there's a national risk assessment produced by the Home Office Financial Conduct Authority. Everybody has a little bit of a say in this, and their findings in relation to risk, they say that there are key risks in the accountancy sector, and that complicit accountancy professionals are facilitating money laundering, as people knowingly getting involved in money laundering for whatever reason may be, usually a monetary value to themselves. But some professionals are willfully blind to their money laundering risks, and that is quite true in some of the inspections that I've done. Not a lot, but some people are blind to what their requirements are. The criminal exploitation of negligent and unwitting professionals. So not really understanding what you need to do, and being negligent in how you carry out your role as a bookkeeper, and some organised crime criminals will exploit that. And the National Economic Crime Centre, which is one of the bodies involved in money laundering legislation, their recent finding was that organised crime groups are actually targeting naive accountancy professionals in order to engage in money laundering activities. So they'll go and seek out somebody that is naive, doesn't ask the right questions, doesn't ask for ID, doesn't verify who they are, and they'll seek them out and to try and launder their ill-gotten gains through a business that they'll have that bookkeeper is looking after for them. And again, later on in the series, I'll give you some stated cases in relation to where that really is highlighted in relation to seeking out those types of people. So what does this mean for you as an ICB bookkeeper? Well, it starts off with Regulation 18, and I want to try and make this as straightforward as possible, but obviously with it being legislation, some of it's a bit dry. But one of the main things is you've got to complete a whole of practice risk assessment, or a whole of firm risk assessment, as it is sometimes called. That is the first step in AML compliance. It's having a look at your practice and what are the risks to your practice of having those clients as clients. And you must take appropriate steps to identify and assess the risks of money laundering and terrorist financing to which your practice is subject. And that's taking into account the size and nature of your practice. If you've only got a few clients, then the risks could be conceivably lower than if you've got a larger practice. You potentially got more risks. However, that doesn't always work that way. You may only have a couple of clients who are really high risk clients, and therefore the risk is considerably higher. And you must take into account the information provided by ICB and by the National Risk Assessment, as I alluded to on the previous slide, and they're both on the ICB website. And again, like I'll always say, you may get fed up of me saying this, if you need any help, there's plenty of us around to ask for help. More than happy to. If anybody wants to email me and to discuss anything that we talk about here, more than happy to do that, like a lot of people did last week. The risk assessment template must be used, which is on the ICB website, and there's a sample template next to that. So you've got the blank template along with a sample, a fictitious company, which Steve Hardwick has created, and he's filled the template out to show you exactly what is required. And I'll come on to that a little bit later on with the content of that. And that will be looked at as part of the AML compliance inspection. That regulation has always been in the part of the 2017 money laundering regulations. We only insisted on it being completed as of the beginning of this year, but still I'm going and inspecting people right up until this week, and it's still not being completed. People are unaware of that requirement, that it needs doing. Some are aware of it, but found it too difficult to complete. And as I say, if you're in that category, just speak out and reach out to me. You've got to look at 5 various areas of your practice and establish what the risk is. The first one is client risk. What is the risk of the client? Now, if you've got your client on AML Online, this does it for you. So you input your client onto AML Online, you've got all that series of questions on there, and it goes through it and it'll establish what the client risk is. And for those of you who are doing that already, fantastic, and it'll come out and show you whether it's high risk, medium risk, or low risk. So you've got to consider the following question: does the client or its beneficial owners have attributes known to be frequently used by money launderers or terrorist finances? And I've got a series of questions you need to ask yourself in relation to client risk. And again, I put them all on here so that you can look at them at your leisure once the session has ended. So client risk is the overall money laundering and terrorist financing risk posed by the client based on the key risk categories as determined by the business. The client's risk profile may also inform the extent of the checks that need to be performed on the associated parties, such as the client's beneficial owners. If somebody comes out high risk, you may need to do some enhanced due diligence on them. So the profile will lead you down certain paths. Undue client secrecy or unnecessary complex ownership structures can both point to highlighting risk, because of company structures that disguise the ownership and control are particularly attractive to people involved in money laundering. Again, if that comes up, you can follow the enhanced due diligence route to try and get to the bottom of what's going on. In cases where a client, an individual or beneficial owner of a client is identified as a politically exposed person, an enhanced level of due diligence must be performed on the PEP. So that's just a brief synopsis of some of the questions that will come up for you to identify the client's risk. Next, we move on to the service risk. A business should consider the following question: do any of our products or services have attributes known to be used by money launderers or terrorist finances? Is there anything that you do, any service that you provide that might be attractive to a money launderer? The service risk is a perceived risk that certain products or services present an increased level of vulnerability in being used for money laundering purposes. Businesses should consider carrying out additional checks when providing a product or service that has an increased level of money laundering vulnerability. So again, doing some enhanced due diligence, a closer look at what's going on. Services and products in which there is a serious risk that the business itself could commit to a money laundering offence should also be treated as high risk. And before any business begins to offer a service significantly different from its existing range of products or services, it should assess the associated money laundering and terrorist financing risks and respond appropriately to any new or increased risks. You might get somebody asking you to provide a service that you don't normally provide. And some people aren't happy with doing that, so they'll turn the business away. Some people are quite happy to provide that service. Provided you're qualified to provide that service, it's not a problem. But if it's a new service that you're providing, make sure that you understand the risks associated with that service. So the next area that you need to look at to do your whole of firm risk assessment is the geographic risk. Again, consider the following question: are clients established in countries that are known to be used by money launderers or terrorist financiers? Geographic risk is an increased level of risk that a country poses in respect of money laundering. And when determining geographic risk, factors to consider may include the perceived level of corruption, criminal activity, and the effectiveness of the controls of the money laundering controls within that country. Is a country, and again, a lot of this will apply to a lot of people whose clients are all locally based. But if you're dealing with somebody who's got business areas in these other countries, just have a look at that country. Do a search on the internet to see what the risks are associated with that country, and build that into your risk assessment. Businesses should make use of public available information when assessing the levels of money laundering risks of that country. Although some countries may carry a higher level of money laundering risk, those businesses that have extensive experiences within that given country may reach a geographical risk classification that differs to those that only have a limited exposure. So if you've got a client that's always been doing business in that country, then the risks may be lower because they understand it. They could be higher because they understand it and they know how to bypass certain things that are in place. But if it's somebody that's just doing a one-off transaction, maybe with a country, they could be perceived as being a higher risk because they are inexperienced at dealing with that country. And these high-risk countries are the countries which I'm sure a lot of you would be aware of. Afghanistan, the Americas, Barbados, Botswana, etc., etc. They're the high-risk countries. So if you've got anybody dealing or got a business interest within those countries that you're looking after, you just have to make sure that's included and do your enhanced due diligence of that client. So the fourth one is sector risk. A business should consider the following question: do our clients have substantial operations in sectors that are preferred by money launderers or terrorist financiers? Things like sectors which are perhaps cash businesses. There's certain sectors that are purely cash. Taxi drivers, some market traders deal purely in cash. Have a look at that. Is that a risk, and how are you going to mitigate it? Sector risks are risks associated with certain sectors that are more likely to be exposed. Businesses should consider the sectors in which their client has significant operations and take this into account when determining a client's risk profile. When considering what constitutes a high-risk sector, businesses should take into account the findings of the most recent UK National Risk Assessment, as we spoke about at the beginning of the session, together with any guidance issued by the relevant money laundering supervisory authority, ICB. So again, you're looking at what sectors your clients are working in. And then finally, the delivery channel risk. You should consider Does the fact that I am not dealing with the client face to face pose a greater money laundering risk? Well, yes, it does. You really need to be meeting all your clients face to face. Certainly in this current climate, or if you can't meet them face to face, certainly a Zoom or a Skype call, FaceTime, whatever it may be. Make sure that you know who you're dealing with, particularly in these sorts of times. Certain delivery channels can increase the money laundering risk because they can make it more difficult to determine the identity and credibility of a client, both at the start of a business relationship and during its course. For example, delivery channel risk could be increased where services and products are provided to clients who have not been met face to face, or where a business relationship with a client is conducted through an intermediary. Just make sure you know who it is that you're dealing with. You've verified their identity, and you're happy that the business is, in fact, what it says it is. Businesses should consider the risks posed by a given delivery channel when determining the risk profile of a client and whether an increased level of due diligence needs to be performed. If you're not certain, then do some enhanced due diligence until you get to where you want to be. Make sure that you're happy with the person you're dealing with. So this is what for those that haven't seen it, a whole of practice risk assessment looks like. There's a first page to this which shows you, tells you what to do. And step one is to give an overview of your profile of your practice. There, as you can see, this first paragraph explains what the practice is, where the clients are, what sort of business you undertake, and then towards the bottom of that document, it shows the consideration of the greatest risk areas posed by clients might commit money laundering through that practice. They're the risks unique to your practice. What you think. A lot of them, or some of them, are generic risks. So you detail there for those 5 areas. Look at them. What are the risks? Detail them down there. And then what you've then got to do is mitigate those risks. How are you going to try and identify it if somebody, for argument's sake, their number 3 on the list is over and under invoicing of goods and services? What are you going to do to try and mitigate that? If you've got a cash-based cash-based client and you're concerned about the cash, how are you going to mitigate that? Are you going to try and ask your client to use not use cash, use a credit card or credit card machine, or ask the client to bank their money on a daily basis, which I know some bookkeepers do? So then at least it narrows down the opportunity at that stage in relation to trying to work out which cash is which if you needed to. Again, there's various ways you can do these things, but that's the risks that this fictitious company has identified. The risks. Then going on to the next page, you then say how many clients you've got on AML Online. In this case, you've got 19 clients on AML Online, and this is why it's important to have your clients on AML Online. So you can see you've got 19 clients, 3 high, 6 medium, 10 low, and you then give an overall assessment, your assessment, and it's subjective, your assessment as to where you feel your practice sits in relation to high, medium, or low as a practice. And then you say on there about your practice, whether you've amended any AML risk ratings, because as you know, you can alter the risk ratings on AML Online. If you've altered them, why you've altered them, and then further details about your practice. Going hand in hand with that, that was Regulation 18, the whole of firm risk assessment. Regulation 19 requires you, in addition to that, to establish and maintain policies, controls, and procedures to mitigate and manage effectively the risks of money laundering that you've identified in your practice risk assessment. So you've identified the risks. So Regulation 19 now says, how are you going to mitigate those risks? Now, again, the policies and procedure statements is available to download on the ICB website, which you should use to implement into your practice. Now, that document that you download lists some generic risks which are generic risks that you can sign to say that you're going to that's your policies and controls and procedures. You've then got to mitigate the risks that you've identified in your whole of firm risk assessment. Now, where you detail that mitigation is a matter for you. You can detail that mitigation on your whole of firm risk assessment. So you've identified the risk. This is how I'm going to mitigate it. Or if you so wish, you can attach a document to the back of the Regulation 19 Compliance Policies and Procedures Statement that you've downloaded from the ICB website and put your risks, mitigate your the risks on the back of there. One thing I will ask is that I've been finding recently some people are downloading the whole of firm risk assessment and copying it verbatim, so not looking at their practice to see what the risks are to their practice. They're just copying the form that Steve Hardwick's put on there as an example, and some people are copying it and it doesn't make any relevance to their clients at all. So I just ask that you make that unique to your practice, identify the risks, mitigate the risks, and then you're all the way there. And any staff and subcontractors must be made aware of your policies and procedures and know where to find a copy. Again, once you've completed that, just make sure that your staff are aware of it, are aware of what you've identified as the risk. And some members will engage with their staff to write this document, get some input from them. So as long as they understand what the risks are and how they're going to be mitigated, and again that forms part of the inspection. Not so much now when there's not many staff around when we're doing the Zoom calls, but when we do the face-to-face inspections, they are we'll speak to your staff members and ask them if they're aware of your policies, controls and procedure statements and the whole of firm risk assessment, etc. So that's covered off the whole of firm risk assessment and the policy, controls and procedures statement. Just in a short bite. Next week we'll do some further legislation and your responsibilities. If anybody's got any questions, I'm here to answer any questions that you may have. For those of you who don't wish to answer now, or ask a question now, or have something once the session's ended, it's not a problem. Just email me at mike.jardine@bookkeepers.org.uk and I'll either respond to your email or give you a call, and we can discuss it like many of you did last week. Thanks very much.
Yep, Mike. So I've just got a couple of questions. So the first one is from Claire Kendall. Hi, Claire. So would you say the 6 stages? Again, Mike, I didn't get the chance to take them down. I think that's at the beginning of the presentation.
Yeah, certainly. So the 6 key functions are identification of risk, prevention of risk or the mitigation of the risk, the monitoring of the controls that you've put in place for their effectiveness. And again, don't be afraid to change those if they're not working or you think they need tweaking a little bit. Again, hand in hand, really, the detection of failings. So when you know something's gone wrong, at least you identify it. The worst thing you can do with risk is your control doesn't work and you don't identify it. The resolution of issues, and ultimately, if you have to, the reporting of suspicious activity if you've identified that suspicious activity. So that's 1, identification of risk, 2, prevention of risk and mitigation, 3, monitoring of controls for effectiveness, 4, detection of failings, 5, resolution of issues, and 6, reporting of suspicious activity.
Great. And then, so we've got another question from Chris. Hi, Chris. So if I only supply consultancy services to one of my clients and they already have a bookkeeper, do I need to assess them for AML?
Again, it all depends. Are you what services are you providing for that client? Is that client, and who's paying your invoice? Are you providing that service and they're providing you, you're invoicing them? Again, it depends what services you're providing. I mean, if that's something, if you wish to drop me an email, we can perhaps discuss it one-to-one.
Great. And then one last question so far anyway, from Julie. Hi, if you complete the AML online, does this mean we don't have to complete the national risk assessment in addition?
Well, you don't complete the national risk assessment. The national risk assessment is provided by the powers to be, the Home Office and the Financial Conduct Authority. You have to complete the AML online. That risk assesses your client. You then have to complete the whole of firm risk assessment, that document that I've just gone through, and that risk assesses your practice. So you're risk assessing the client, and then you've got all your clients risk assessed individually, and then you risk assess your practice. So you can say, this is my practice, and these are the risks my practice faces with all these clients who have already risk assessed. So you have to do your AML online and your whole of firm risk assessment and your compliance policies and procedures statements.
Great, thank you. So then, so 3 more questions have popped up. Thank you everyone. So from Jim H. Hi, I've recently taken on to run the payrolls for the clients of an accountancy practice. I invoice the accountancy practice on a monthly basis and use their systems and Dropbox account to communicate the payslips, etc. to their clients.
So in relation to your accountant, you're invoicing the accountant. So the accountant is your client, not the people you're doing the payroll for. The accountant is your client. So the accountant is the person that you put onto your AML online, and the accountant is the person that you risk assess, not the people that you're doing the work for, because it's the accountant's responsibility to do the risk profiles of their clients.
And then a question from Tony D. Mallet. Sorry if I'm not pronouncing that correctly. Similar question. If I'm only supplying software, do I still need to complete AML?
No, if all you're doing is providing software, you don't need to put that particular client on AML online. It's only if you're providing those bookkeeping and accountancy services that they need to be on there.
Great. And then one last question so far from Susanna Whelan. If a company has one director, but also has another person named on company's house as a secretary, do I need to complete checks on the secretary also, even if I have no dealings with them?
No, you do not need to complete your due diligence checks on the company secretary, but you do on all the directors and person with significant control. Company secretary, no, you don't. Great,
thank you, Mike. So that's all. Oh, one more question from Joanne Crompton. If you provide services on a volunteer basis, am I right to assume these need to be put onto AML too?
Yes, you need to put them on, because you still need to, even though you're not charging any fee for them, you still need to put them on there, because you've still got to conform to the AML.
Great. Okay. So I think that's all the questions.
That's fine. Well, as I say, feel free to drop me an email. More than happy to speak to anybody individually if they so wish, if they've got any questions whatsoever.
Oh yeah, another question from Jim H.
Yeah.
Do I need to carry out an AML report for each of the clients, or just the accountancy firm themselves?
If the accountant is your client, so you just forget about the others. So it's just the accountant. So if you're invoicing the accountant, you just need to do it. They need to go on AML online, and that's the person that that's your client that you're risk assessing. As I say, it's a matter for the accountancy firm to do the other clients.
Great. All right, thank you, Mike. I believe that's all the questions. Anything else, Paul, for you?
No, not for me. Just reiterate, just drop me a line if you need anything.
Yeah, thank you. And just to remind everyone that it is indeed Global Bookkeeping Week, and everyone at ICB is really excited, and we're looking forward to the Bookkeepers Summit. There are still tickets available, and don't forget that on Wednesday it is Razor Cup Day, and throughout this whole week, we will be celebrating the great work that bookkeepers have done this year. And yeah, make sure you get involved. Right. Thank you, everyone.
Cheers. Thanks very much.
Bye.